Welcome back, students, to yet another teaching lesson in economics, which is again titled Money in Banking, because we are moving forward with the next part, which is essentially the last part of this topic. So let's move on. In this teaching module, we will study about the quantitative measures of money supply, the qualitative measures of money supply, as well as we will learn about credit creation by commercial banks. Let's look at the measures of monetary policy. Now, we know that the RBI is the monetary authority of the country. And so, in times of inflation or excess demand, when people have too much purchasing power, and also when there is deflation, that is when people's purchasing power reduces, it is the RBI that will take certain decisions and actions in order to promote a healthy economy. So we are looking at these measures or actions or decisions of the RBI, which we call as monetary policy measures. The first type of monetary policy measures is quantitative measures. Now, the quantitative measures regulate the total quantity or amount of credit in the economy without taking into account the uses to which that credit will be put. So let's look at the first quantitative measure, and that is bank rate. Now, what is bank rate? The bank rate is the rate at which central banks give credit to the commercial banks. Any increase or decrease in bank rate is often followed by an increase or decrease in the market rate of interest. Now, the market rate of interest is the rate of interest that the public pays to commercial banks when they might take a loan from them. So, if the bank rate, that is the rate of interest that commercial banks have to pay the RBI, changes, obviously the market rate of interest will change. Thus, the cost of credit is increased by increasing the bank rate. Now, during inflation, this reduces the flow of credit. And during deflation, the cost of credit is reduced by reducing the bank rate. And this will eventually increase the flow of credit. Because in times of inflation, if the bank rate is increased and people are discouraged from taking loans, so they are able to control the situation of inflation. And in times of deflation, when they are encouraged to take loans because the bank rate has been reduced and subsequently the market rate of interest has reduced, people will be encouraged to take a loan and their purchasing power will increase. The second quantitative measure is open market operations. This refers to the sale and purchase of securities in the open market by the central bank. Now, the central bank withdraws cash balances from the economy by selling securities like NSEs, that is National Savings Certificate. And by buying securities, the central bank will add to the cash balances in the economy. If cash balances are increased, the flow of credit will increase by something called as a multiplier effect. So if there is inflation and excess demand, then the RBI will sell securities because people will come forward with their cash balances to the RBI, and thereby the cash balances in the economy will reduce. And if there is deflation and deficient demand, the RBI will have to buy the securities from the people. And by buying, they will increase the purchasing power of the people and thereby control deflation. The third quantitative measure is cash reserve ratio or CRR. This refers to the minimum percentage of a bank's total deposits that they are required to keep with the central bank. So certain amount of cash reserves or deposits are to be kept with the central bank. Every commercial bank has to. So commercial banks have to keep with the central bank a certain percentage of their total deposits in the form of cash reserves as a matter of law. For example, if the minimum reserve ratio is 10% and the central bank says 10% of your total deposits you have to keep with us, and the total deposits of a certain bank are rupees 100 crores, it will keep 10 crores with the central bank. 10 crores is a 10% of 100 crores, right? So that amount will be kept with the central bank as minimum reserve. If the minimum reserve ratio is raised to 20%, then the bank will have to keep rupees 20 crores with the central bank. When the flow of credit is to be increased in the economy, this minimum reserve ratio will be reduced. And if the flow of credit is to be decreased, then the minimum reserve ratio will be increased. The fourth quantitative measure is statutory liquidity ratio, or SLR. Every bank is required to maintain a fixed percentage of its assets in the form of cash with themselves. This ratio is called statutory liquidity ratio. The ratio of SLR is always fixed by the central bank. So to increase the flow of credit, the RBI will reduce the SLR. So if the banks reduce the amount of cash that they hold with themselves, that means more cash will be in circulation among the people. And to decrease the flow of credit, the RBI will raise the SLR. Because if they raise the SLR, then the flow of credit will be less. Now let's look at the qualitative measures of money supply. And they are margin requirement, moral suasion, credit rationing, and direct action. The first qualitative measure is margin requirement. Now this refers to the difference between the current value of security offered for loans and the value of the loan granted. Suppose a person mortgages an article or keeps a security worth 1 lakh with the bank, and the bank gives him a loan of 80,000. The margin requirement in this case would be 20%.